Assalamu alaikum. My name is Saeed Haidar Naqvi. I am a student of Economics and Finance third year. My group members Saeed Mahimadul and Sabir Khan. We are going to discuss the presentation about the impact of inflation on financial market decision. Inflation. Inflation is the increase in the level of price of goods and service that household buy. It is measured at the rate of change of those prices, typically price over time, but price can also fall, a situation called deflation. Factor influence inflation: food prices, fuel prices, commodities, development lifestyle, growing income levels. Impact of high inflation on capital market. Inflation translates into higher costs and lower returns. Foreign investors get distance, discourage foreign capital, volatility in stock market. Financial market. Interest rate higher inflation leads to higher interest rate, asset price, decrease stock and bonds value, increase commodity price, currencies, weakened currency due to high inflation, investor behavior, risk aversion seeking inflation protected investment, diversification, inflation indexed instrument, commodities and real asset, active management and inflation strategies. Impact on stock market. Negative impact. Increase buying power. Inflation reduce the value of money, impact consumer spending. Higher interest rate increase lower cost, reduce consumer and business spending. Lower profit margin. Companies struggle to maintain pricing power. Uncertainty. Inflation and volatility makes forecasting difficult. Positive impact. Economic growth, moderate inflation can indicate a growing economy. Increased commodity price benefit commodities-based companies. Rotation to grow stock, investors seek companies with pricing power. Impact of high inflation on investors. Number 1, investors. Number 2, loss in the value of interest on saving. 3, less keen to saving in future. 4, less investment. 5, real-time loss to whole economy.
Assalamu alaikum. My name is Maria Batul. I am the student of Economics and Finance third year. My topic is the impact of inflation on financial market. What is inflation? Inflation is when the price for goods and services increase over time, reducing the purchase of power money. This means you get less for the same amount of money. In slide 1, we will discuss about inflation trends, analyze market impact, adjust investment strategies. Understand inflation trends mean investor may look for the assets that grow with inflation, like stocks or real estate. Companies might adjust prices, expense, or even their business strategies to handle the increased cost. When inflation is high, the value of money decreases. So people, companies are investors have to adjust how they spend, save, or invest to protect their financial well-being. Second column is analyze market impact. Buying or selling stocks. High inflation can make stocks more attractive as companies raise prices, but it also increase risk. Bond investment. Inflation reduce bond returns, so investors may choose inflation protected bonds. Currency decisions. Inflation impact currency values, so traders may shift to stronger currencies. Third column is adjust investment strategies. Understanding inflation help you to make better decision about saving, spending, investing, especially in times of economic uncertainty. This breakdown make easier to understand how inflation affect both individual and large financial market in a straightforward way. In in second slide, we will discuss about challenges for markets. Banks and financial institutions. Due to increased competition and lower interest rate, banks earn less profit from lending activities. Decrease asset value. The value of assets held by banks such as loans and securities may decline during economic downturns, managing inflation linked assets and instability. Traders. Increase market value. Uncertain economic conditions lead to more significant price fluctuations, making trading riskier. Difficulty in pricing assets. Accurate asset valuation become challenging in volatile market. Investor. Reduce purchasing power. Inflation erodes the purchasing power of investors' capital. Uncertainty in assets value. Individual and businesses. As in third slide diagram shows, higher wages, increased demand for labor or other factors can lead to higher wages for workers. Second, raising cost of living rises, the further pushes up labor cost for businesses. Higher prices, businesses pass on the increased labor cost to consumers in the form of higher prices. Increased demand for goods. With higher wages, consumers have more purchasing power, leading to further wages demand and so on. As you can see in slide number 4, we have CPI and PPI measured by CPI and PPI. What is CPI? CPI is Consumer Price Index. This measures the average price of goods, services that consumers buy like food, clothes and transportation. When CPI goes up, it means the cost of living is rising for consumers. PPI. What is PPI? Producer Price Index. This measures the average change in selling prices received by domestic producers. It reflects inflation from the perspective of producers for businesses, showing how much they pay for material goods and services. In slide number 5, we have how to beat inflation. When inflation is high, the value of money decreases. So it's important to make smart financial decisions to protect your purchasing power. Here are 6 strategies. Keep cash in money market, funds or tips. These are safer places to keep cash as tips are designed to protect against inflation. Number 2, avoid long-term fixed income investments. These type of investments don't usually keep up with inflation, so their value may decrease over time. Number 3, emphasize growth in equity investments. Stock, especially those that pay dividend, can offer return that outpace inflation. Consider real estate. Real estate often appreciates in value and can act as the hedge against inflation. Last one is down complex terms and strategies in simple language.
Between inflation, interest rate, and corporate earning. Let's dive into how these elements affect each other when it means for the economy. First, let's look at the relationship between inflation and interest rate. When inflation is high, central banks typically increase interest rate. This makes borrowing more expensive, reduces the money supply, and ultimately slows down economic activity. People have less money to spend on goods and services, leading to a drop in demand, which can cause prices to fall. On the other hand, with low inflation, interest rates tend to decrease. This encourages borrowing, increases the money supply, and allows people to spend more, leading to a boost in demand and higher prices for goods and services. Now, let's examine the sector-specific effect of inflation on corporate earning. High-growth companies, especially those in technology, consumer goods, and biotech, usually have higher valuation and attract momentum-driven investors. However, their volatility also tends to be higher and dividends may be lower. In contrast, companies with slower growth in sectors like energy, utilities, and industrial often provide steadier dividends and lower volatility. These companies are less appealing to growth-focused investors but can be more resilient during inflationary periods. Taking a closer look at, now we will dive into the chart on inflation rate of Pakistan fiscal year 23-24. Taking a closer look at Pakistan inflation rate for the fiscal year 2023-24. We see significant fluctuation starting at 37.97% in May 2023. The rate has generally trended downwards, reaching 17.3% by April 2024. Such high inflation rates wide-ranging effect on consumer purchasing power and the broader economy. Now, the impact of high inflation on stock market. When the inflation is high inflation has negative relationship with the stock market as inflation increases so the cost of companies, leading to reduced profitability. Higher interest rate also push stock prices down as borrowing becomes more costly, impacting both corporate spending and consumer demand. Impact of deflation on stock market. Deflation, while reducing prices, also has negative effect on the stock market. While with falling prices, demand often decreases, leading to production slowdowns, higher unemployment, and reduced profits. This can drag down stock markets, making it a challenging environment for investors. Conclusion. To conclude, inflation significantly affects financial market, investor behavior, and corporate strategies. Moderate inflation can foster growth, but high inflation poses risk. Investors should consider inflation-protected assets and actively manage their portfolios to mitigate these effects. Policymakers, corporations, and investors alike need to be vigilant in managing inflation's impact on the financial market.